I'm Peter Krauth. I'm going to talk to you about silver, and hopefully you're going to agree with me that we're at the start of a new silver bull market. And if nothing else, based on the attendance here today, it certainly looks like there's a new commodities bull market, because we didn't have these kinds of numbers just one or two conferences ago. So hopefully the tide has turned and we're up for some exciting times. The first thing I'm going to talk to you about is some of the main drivers, macro drivers, global drivers that I see affecting the economy sort of worldwide. Then I'm going to talk about how I see those affecting the silver market. So why don't we get right to it? As you probably all know, last year was awful for what we call the 60-40 portfolio. That's Wall Street's moniker for the ideal way to position your portfolio is 60% stocks and 40% bonds. And that has worked for almost 40 years, but not last year. Last year was the worst year since 1999. That portfolio was down 17%. Bonds were down 17%. The S&P was down 19%. NASDAQ down 23%. And if you look at this chart, at least for me, what stood out is that the drawdowns don't happen in isolation. They actually happen or tend to happen in clusters. So the first cluster all the way on the left, almost 100 years ago, was the late 20s and into the 30s. And then about 50 years ago in the 70s, you had another cluster of these drawdowns. So as I say, these drawdowns tend to come in clusters. They're not necessarily in subsequent years. So frankly, my view for this year is that stocks and bonds are likely to do relatively well just because last year was so god-awful. But I wouldn't expect that to last. I think that we're in a new paradigm. Stocks and bonds are really going to struggle with high interest rates over the next decade easily. And so people are starting to look for alternatives, and they're finding them. The next big theme I want to cover is the dollar. So in my view, the dollar has peaked. If you look at the last 40 years or so, the dollar's gone through some big highs and lows, but the peaks stand out as 1985, when the dollar index peaked at 160. In 2002, it peaked at 120. Last fall, it peaked at 102. At 112. Today, we're at 102. And what I want to draw your attention to with this chart is how the run-ups and the corrections in the dollar index tend to look symmetrical. So the amount of time it takes from bottom to top approximately is equal on the downside. So I believe that we've seen a new peak. If you look at the prior bottoms, that blue line all the way over on the right is around the 90 level. I think we're heading there probably this year or next year, and that should be a tailwind for commodities. Inflation. I've been saying that this is the inflation decade. It's not over. And what I want you to see in this chart, which at least for me is what I feel stands out, is that I think the vast majority of people, probably it's an age thing, but are looking at what's happened with inflation and they're thinking, okay, so the last time we had inflation like this was in 1980. Central banks stepped in, raised rates dramatically, and it was over. Inflation fell back, moved sideways, everybody was happy. It was a great party for a few decades, but I think they're wrong. I think they're looking at this current peak as though it was the number 3 over there, which was the last peak at the end of the 70s. And in my view, this current peak is closer to the number 1 all the way on the left, which was that first rise in inflation, that first wave in inflation in the 1970s. And so I don't know how many more waves there could be this time, but I do expect several more waves. And I think that, If anybody thinks that inflation is going back to 2%, which the Fed really wants us to believe, I don't think that's ever going to happen for at least a decade. We're probably looking at 4 to 5%. I think 4% is going to be the new 2%. And so that's what you probably should take away from this chart. There's a lot more inflation to come. It's going to feel better for a little while, but it's not gone away, not permanently. So what happened in the 1970s with stocks? Well, between 66 and 82, this is the Dow. So that yellow circle on the left shows you that the Dow hovered around 1,000, peak was about 1,000, for about 16 years. But the chart on the right shows what happened to the Dow if you account for inflation during that time period. So stocks actually lost, and this is a broad market index, actually lost 70% after inflation over 16 years. So I think this is the kind of environment that we're back into at this point. And as much as central banks are tightening and want to make us feel like the liquidity is being drawn out, I think we have governments that have quickly stepped in. It's maybe not that obvious to everyone, but in my view, the money printing continues. And here are a couple of examples just in the US. You have the US Infrastructure Act. That's the equivalent of $1.2 trillion of spending over the next several years. A lot of that's going to go into some good things, transportation, roads, bridges. One example that's good for silver, our sector, is $7.5 billion of that money is going to go into a national network in the US for as much as half a million EV chargers. Then you have the US Inflation Reduction Act. That's meant to reduce carbon emissions by about 40% by 2030. It's going to see $370 billion go into spending for renewable energy and climate measures. And this is going to have huge impacts on the solar industry, which I'm going to touch on a little bit more later. So here there are actually two themes, one a smaller theme, but no less important. I think we're into a new age of deglobalization and de-dollarization. Because of COVID in part, but I believe we were already trending that way before. That just sort of triggered a faster pace of it. The world's becoming polarized. We're heading towards scarcity in commodities of all kinds. You've got countries now, especially with a war raging, that are looking to onshore supply. Manufacturers, governments, people are willing to pay more, not happily, but willing to pay more for security of supply of all kinds. You know, if you look at what's happened with the war in Ukraine, war hurts supply chains. It boosts demands for commodities. When you're blowing things up, one, you have to replace those weapons. Two, you have to rebuild everything that you blew up. That's fantastic for things like steel, copper, cement, energy. Europe's living through an energy crisis that has eased up a little bit because of the weather and because they've had to try to scramble and pivot quickly to look for other sources of reliable supply other than Russia. But this war has actually dramatically impacted all kinds of commodities. You've got difficulty getting all kinds of food from the Ukraine, from Russia, grains. And then you have, again, local sourcing for raw materials, where countries are looking for more friendly suppliers of food, metals, energy, all of these sorts of things. And then the US dollar being weaponized by the US by freezing Russia's treasuries has all kinds of sovereign wealth funds, large institutional managers, high net worth families and individuals looking at that and saying, is my exposure to the US dollar too high? Look at what can happen. And so that's another sort of notch in the decline of the dollar. And so you have now the development of things like Russia and Iran talking about a gold-backed stable coin so that they can trade between each other and note not just a cryptocurrency, but a gold-backed currency. So that tells you where their faith lies. Then you have China and Saudi Arabia talking about a new petro yuan. So that is going to mean the end of the petrodollar. Saudi Arabia will be happy to accept yuan for its oil, and that's a new sort of friendly arrangement that's starting to develop as well. So what are the implications of all of this for silver? Well, we have, I believe, seen already this pivot start to happen. Since September only, the dollar index is down 10%, gold is up 15, silver is up 24, and the gold and silver miners are up 34%. Now, here's a little interesting note. Crypto hasn't escaped anyone that crypto is now probably in an extended crypto winter with all these things blowing up and all these cryptocurrencies struggling and losing massive market caps. Well, people who are comfortable with crypto obviously have seen that happen. They've suffered and they're starting to look for alternatives. Well, it's interesting to note that the two largest gold-backed cryptocurrencies, Paxos Gold and Tether Gold, if you look at their combined market caps, that's already at $1 billion. So I believe younger investors that are comfortable with crypto are starting to get comfortable with gold-backed crypto and gold and precious metals in general. We talked about the dollar. Here's a little more interesting support for silver. US dollar weakness is very supportive for silver. If you look back over the last 20 years or so, there's a negative 80% correlation between the US dollar and silver. And so a weaker dollar is a fantastic tailwind for silver. And as I say, I believe that we're at the beginnings of a long-term bear market for the dollar. Switching gears to fundamentals, it's interesting that silver producers are struggling. The two largest silver mining countries are Mexico and Peru. And since 2016, they've both seen their production peak. Now, not only has it peaked, but ore grades are falling off. New mines coming into production are falling off. So there's a real dearth of new silver supplies and silver mines coming on board. And this in the face of the highest demand in decades. In fact, it's probably an all-time record high in terms of silver demand. The Silver Institute tells us that last year's demand globally was 1.2 billion ounces. That was up 16% over the prior year. Industrial demand, which is half of all silver demand, was up 6%. That's led by the green transition, solar EVs, etc. Physical investment was up 18%, silver jewelry 29%, and silverware up 72%. So across the board, almost invariably, every single sector that uses silver was up very strongly last year. And this in the face of supplies. So this chart shows us that in 2020, there was almost a 70 million ounce supply of silver. So when we got to 2022, just 3 years later, we were looking at a huge swing from 70 million ounces plus to almost 200 million ounces in the negative. That's a tremendous swing that happened in just 2 years, 3 years, and I think it's indicative of what we're going to see. The Silver Institute believes that we're headed for several more years of deep deficits. Now, silver being so important to solar, let's look a little bit at what we see going forward in terms of expectations for solar installations. The US, in part because of the Inflation Reduction Act, sees that solar panels are going to see triple the amount of current installations over just the next 5 years. And according to the International Energy Agency, the same thing is expected to happen globally. So the demand for silver, which is the single biggest demand factor for silver on the industrial side, is going to continue ramping up very, very rapidly. Right now, solar is 12% consumption of all the silver supply every year, and yet it just represents 3% of global electricity output. The International Energy Agency also tells us that they expect that by 2030, so just 8 years from now, they expect solar capacity to be up 8.5 times. So if you do the math, simple math, current consumption by solar, 140 million ounces, up by 8.5 times, that gives you almost 1.2 billion ounces, which is the current annual supply of silver. So where all this silver is supposed to come from, I don't know, especially with mines struggling and the biggest producers struggling. So it's very attractive for the outlook. I think silver is going to be considered very, very soon as a critical resource. It's the most reflective and most conductive metal. It's actually a benchmark. All the other metals are measured against silver's conductivity and reflectivity. We talked about the consumption of solar, automobiles, and electronics both are going to see as much as 50% more demand for automobiles in the next 3 years, for electronics in the next 8 years. I think we're going to see manufacturers really start to seriously pivot towards trying to secure supply. There's all kinds of ways you can imagine that they're going to do that, but silver will become a really hot commodity. Supply from mines, interesting to note that only 30% of silver comes from primary silver mines. Almost 3/4 of silver comes from mining other metals. So although demand for silver might go up dramatically and it's irreplaceable in a lot of its applications, most of the miners that produce silver actually produce it as a byproduct. So they're not that swayed by higher silver price. They see it as an afterthought. So imagine higher demand for silver and virtually no reaction from the mining industry in terms of production. That means silver supply is inelastic, and that'll just feed even higher prices. If you look overall, silver is still quite cheap. It's 50% below its all-time high, 90% below its inflation-adjusted all-time high. You can't say that for any other metal. None of the major base metals, platinum group metals, precious metals. It's truly an exception. In the 70s, silver easily outperformed stocks. Even gold was up 1,400%. Silver was up 3,700%. And if you look back at the last 22 years, you ask the average investor what's the best place to have been, they'll probably tell you stocks. The S&P, the Dow did okay, up 200%. Silver was up 370, gold up 520. And silver outperforms gold in bull markets. So if you look at 1980, that's silver up at the top. The percentage gains were dramatic against gold. 2011, silver easily outpaced gold. Right now, at where we are all the way on the right, silver really has a lot of catching up to do versus gold, and I think we've seen the beginnings of that in the last few months. This is one of my favorite charts, more on a sort of a near-term basis. So this is the top line in black is the silver price if you figure that the SLV ETF represents the silver price. The bottom line in blue is the outstanding shares in the SLV ETF. So the outstanding shares is a reflection of demand for that ETF. All the way on your left, you'll see that in 2020, when we had the panic from COVID and silver took off and went from $12 to $30, in that same time span, the outstanding shares for SLV exploded and followed the silver price up. So that meant that investors were participating and they were convinced and they got on board. Now, if you look all the way over on the right, in the last 4 or 5 months or so, when silver bottomed and went from 18 to 24, the outstanding shares, that blue line at the bottom, is flat. So that tells me silver is hated. People are not paying attention. Silver has already gone up 33%, and nobody's following it. So that's the kind of timing that you want when it's starting to move. I'm going to try and move a little quicker here. I'm slowly running out of time, but gold and silver miners, if you look kind of globally, precious metals versus the S&P, miners are one of the single most undervalued sectors you could look for. We're rotating now from growth to value. Well, when value starts to move up in general stocks, then they're going to start looking for even deeper value, and they're going to find it in the mining shares. They're throwing off the large companies are throwing off some fantastic yields. And as this chart shows you, they have their highest cash levels in history. So that is something they're going to start putting to work. And this is something to retain. If you look at all the way on the left, the white line is aggregate cash flows. So a buildup of cash by mining companies between about 2009 and 2012. The green bars are the M&A activity. So there was a lag, but it followed it quite closely. Then if you look further on the right, the white line went up. That's these cash flows I just mentioned, but the green bars are almost flat. That means there's been almost no M&A activity, and I think that's going to start to happen. You're going to start to see these bigger companies use their cash, use their shares as a currency, and start acquiring some smaller plays and start replacing their reserves and start building their production. Returns by majors in the last bear market. This gives you some perspective. Pan American between 2001, 2008, up 16 times. Wheat and precious metals up 17 times between 2008 and 2011. And I believe this is my last chart, gives you some perspective. This is the Silver Juniors ETF versus the S&P. So this is a ratio. And as you can see all the way over on the right, this has been gaining dramatically in the last 5 or 6 months, since August or so. So the Silver Juniors are starting to dramatically outpace the broader market. Now this ratio is over its 200-day moving average. That's very bullish. The 50-day moving average for you technical analysts out there has crossed above the 200-day, and so that's a golden cross, as we call it. So I think that juniors are poised to rally. There's different things they can do to support their share price, add great assets, find more value through exploration discovery, expand their resources, advance projects, and they can find creative ways of generating income. That's something to look at. Hopefully, if they do well, they leverage the silver price, and there's the M&A wave to be ridden. And so I believe now is the time to position. I talk about this a lot more in detail in my recently published book, The Great Silver Bull. It's now available in an audiobook version. And if you want to follow me, you can go to silverstockinvestor.com. And I'm also on Twitter and on LinkedIn. Thank you.